Good morning. It's Friday, the 3rd of October, and this is Govindraj, Ethiraj broadcasting and streaming weekdays from Mumbai, India's financial capital, as we return from a holiday. Our top stories and themes: the stock market stage a rebound. Will it last? The Reserve Bank brings the banking system closer to the capital markets even as it maintains interest rates. Oil prices drop even as the rupee gains. And the role of decentralized finance in supply chains.
This is the Core Report with Govindraj Ethiraj.
A rebound. The Reserve Bank unleashed a series of moves on Wednesday aimed at providing more boost to corporate and individual borrowing, including for initial public offers or IPOs. The changes will now allow banks to lend for acquisitions by Indian companies, a segment so far dominated by foreign lenders and credit funds, and evidently in response to banks themselves seeking greener lending pastures, so to speak, in contrast to traditional ones which have slowed down a fair bit. The Reserve Bank of India also allowed, as Reuters said, unfettered bank lending against listed debt securities and also raised the limit for lending against equity shares from about 20 lakh rupees to 2 crore rupees. The cap on bank financing for IPOs will also be raised to 25 lakh rupees from 10 lakh rupees per individual. Now, all of this obviously means the banking system has inched closer to capital markets, which is somewhat new and represents a return to a past, and either way deserves some deeper analysis, which I will come back to next week. Now, the Reserve Bank also said it would withdraw a 2016 framework that limited bank lending to large corporations in a bid to reduce the risk of concentrated loan exposure. This was then. So this change will now allow banks to raise lending to big companies. All of this marks a shift in stance, mood, and a general overview of how India Inc. and its creditworthiness is viewed by the banking regulator and thus, by extension, the banking system. Meanwhile, on Wednesday, the indices snapped their longest losing streak in 7 months, thanks to gains in banking stocks, following obviously everything that we just spoke about. And yes, the Reserve Bank did not change interest rates for the second straight meeting, keeping the repo rate at 5.5% and maintaining its stance at neutral. It also kept the GDP, or the gross domestic production projection, for 25-26 unchanged at 6.5%. It continued to lower its 25-26 consumer price inflation forecast to 3.1% against its earlier forecast in the June policy at 3.7%. With all this good news, at least for Wednesday, the Sensex was up 715 points to 80,983 and the Nifty 50 was up 225 points to 24,836. In the broader markets, the Nifty Small Cap 100 Index rose 1.1%, while the Nifty Mid Cap 100 Index rose 0.89%. Some of the sectors which did well were Nifty Bank, Auto, Realty, and Nifty Financial Services, Energy, FMCG, IT, among others, according to Business Standard. Now, internationally, markets are doing well, better. The MSCI's broadest index of global stocks was up about 0.25% on Thursday after European stocks hit another record high, up about 0.6% according to Reuters. Wall Street futures were also up Thursday morning. Tech stocks in Asia are still going strong, lifting the region's indices. And gold has hit another high while we were away for a Thursday holiday, hitting about $3,895 overnight, while also supporting US Treasuries, sending yields sharply lower, according to Reuters. Oil prices are down now almost quietly, which translates into I did not pay much attention in the last couple of days. Brent crude is now quoting below $65 a barrel. Speaking of oil, Reuters is reporting that India's diesel exports to Europe has probably hit an all-time high in September as traders cashed in on profits in the West during a refinery maintenance season. So India's refiners, which source about a third of their crude from Russia, are boosting runs and redirecting surplus products abroad, with gasoline and diesel shipments hitting multi-year highs, says Reuters. Now, all of this is precisely the United States' stated problem on India importing cheaper Russian crude and exporting finished product to Europe, and thus, of course, allegedly funding Russia's invasion, or rather war with Ukraine. Meanwhile, the rupee went higher on Wednesday, which made its best day in 2 weeks, even as the dollar slipped broadly as the US government shut down, and that's where it currently stands. The rupee closed at 88 rupees 69 against the US dollar, up 0.1% on the day, the most since September 17th, according to Reuters. The dollar has now slipped to a 1 week low against its major peers. So, Wednesday's rally notwithstanding, what are the broad trends in the market given that earnings have been slow for some time and overall valuations are still seen as stretched? I spoke with Chakri Lokapriya, CIO or Chief Investment Officer of Equities for LGT Wealth based out of Chennai. And I began by asking him what was going on in the market and where it was going right now before asking him also what he was liking in terms of sectors in these markets right now.
Currently India has one of the highest tariffs in the world at 50%, with the base rate of 25% plus a punitive rate of another 25%. So against that backdrop, earnings for Indian corporates have slowed down, and they're preserved to probably about 6 to 8%. And therefore, the market returns would more likely be around the same number, around 6 to 8% over the next 12 months. On the other hand, if this punitive 25% is removed and if it comes down from 50 to 25%, then you're very likely to see a significant earnings upgrade, and therefore the market returns would be significantly higher, north of 12-14% for the next 12 months. So I guess it's all come down to now the tariffs are the primary worry, and the rate of tariff at 50%. If it comes down, then I think India will be in a far better shape.
Right. But before the H-1B visa fee was announced, the markets had recovered whatever they had lost to that punitive 25%, or for that matter, the cumulative 50%, isn't it?
Yeah, absolutely right. I think what the H-1B $100,000 fee kind of showed to the market is basically it's not just tariffs. The US can devise other methods of making it more difficult for Indian companies to operate in the US. And so with the H-1B, the tariff of 100,000, clearly the profitability of Indian IT companies comes down. Well, the numbers are only about 2 to 4% on the earnings and the profits growth. But what it does is that overall model, which has been built over the years of, using cost advantage to India's benefit. So that goes away, and it has kind of taken away some kind of confidence from the system. And that is largely the reason of the current markets having a very cautious outlook.
Right. And if you were to look ahead now, what would you say are the significant or not so significant triggers that could drive prices or performance?
Yes. Today India is actually an interest rate cutting cycle. Fortunately, that is very good for the equities markets, because the lower the cost of borrowing for companies, then the higher the profit margins, and therefore higher the markets. So India still has a good interest rate differential between India and the world, and therefore has the ability to cut rates far more. And also with the recent GST cuts, inflation is also coming down well under control. So these will act as cushions to the market. With an inflation under control, GDP at about 6.2%, I think the markets have the downside intact, and therefore there's not much downside at Fed levels.
And, we've been waiting for an earnings upgrade for several quarters now, or a shift in earnings outlook, which has not happened in the way we thought it would happen, or at least at the pace at which we were hoping it would happen. But what's your sense as we are now entering the next quarter of the current financial year, or rather having started the next quarter of the current financial year? Are things looking any different? Are you able to see anything around the horizon or over the horizon?
That's a good question, because basically companies are waiting for the dust to settle down in terms of, where is the final tariff number that's likely to be. And until then, the capital expenditure plans of the private sector of the companies are largely on hold. They're doing the incremental bids where it is necessary, but beyond that, no. So the heavy lifting is actually being done by the government-owned companies, the PSU banks, as well as the PSU companies are doing the heavy lifting. And that will continue to support the market. This earnings upgrade is likely to come. One, with the GST cuts, there has been some amount of earnings upgrade that will come about in the next quarter. Second, clearly the tariffs. And third, the interest rate cycle further going down will provide us the third catalyst.
And you feel that interest rates going down is a sufficient catalyst to change earnings profile of companies and therefore market response to that?
Fortunately, the Indian equity valuations are at very reasonable levels. They're probably at 19-20 times. To put this into context, they're very close to those numbers that we saw during the COVID lows. So which means clearly that was a far more significant event than today's tariff situation. So the downside is very limited. On the other hand, it has come down to the removal of uncertainty. It is like a switch. If that comes about to a change where the punitive tariffs go away by, let's say, November or December, then you would see a lot of companies stepping up to the plate and therefore leading to an earnings upside.
And you're saying that private capex could be a trigger for this.
There are two things. One is that the government capex is fortunately intact. The government has continued to spend. So that all the government companies, you would see some earnings upgrades. On the other hand, the private companies, they would wait for more the global cues to come about. And the interest rate cycle also to probably next month will be another rate cut. So when that happens, we will I think we will begin to see the private sector also joining in making their plans and therefore having earnings upgrades.
Right. Let me take a step back now. I mean, geographically, that is. You are a global fund as well. So a lot of funds are actually pulling out of India right now. I'm talking about global funds or emerging market funds. And China is looking very hot for various reasons, including tech. And this is a sustained phenomenon, as we are seeing now foreign portfolio investors selling continuously. And even though Indian investors are buying, they're only able to barely provide a cushion to that selling that's happening. So my question really, I guess, is how are you seeing it if you take a step back and look at the region now and where India stands?
India has, because of the tariffs, has actually been one of the poor performing markets if you compare it to other emerging markets. And that has also led, because of this uncertainty that we spoke about, has led to corporates holding back, and that has led to an earnings slowing down. And when earnings slow down, then, foreign investors usually look for markets where there is an acceleration of earnings. China has been in a not so good place for the last few years. You're seeing some signs of it an uptick, and therefore they're moving towards China. But as far as India is concerned, that FII selling is likely to abate only when we see some kind of a resolution to the Trump tariff at about 50%.
Right. And I noticed that in various other conversations, you've talked about sectors that look good or promising despite all of this. You've talked about, for example, metals and auto ancillaries and banking. So tell us, I mean, first, thematically, what looks good or how do you spot opportunity in this kind of environment? And therefore, what's driving those theses? And secondly, what specifically or specific sectors that are you looking at?
India, fortunately, is a domestic economy. 85% of all the demand is domestic in nature, and only exports form only less than 12-14% of the overall pie. So from that perspective, despite the tariffs, you will have the domestic facing companies, which is financial services, consumer discretionary, and industrials. These three segments actually continuing to do what they do. And as far as financial services and consumer discretionary is concerned, they will benefit from an interest rate cut because whether you want to buy a bike or you want to buy a car or a home, lower interest rates makes lower EMIs and therefore make it more affordable to go out and buy. And second, now the GST rate cuts is a significant boost. As we've seen, two-wheeler, four-wheeler sales have actually picked up post the GST rate cuts. And third is industrials. Infrastructure development is very key to India's growth. And the Indian government has done a very good job, but through the Indian PSU government-owned companies doing infrastructure spends. I think that as a theme will continue. So these are the domestic-facing sectors that we would like to look at.
Right. And is there any specific view on metals and auto ancillaries? Because I heard you talk about them earlier. So
Indeed. Metals actually, fortunately, are in a good space. What has happened in the case of metals is, the tariffs are universal, and therefore the Indian companies are not at a disadvantage, unlike other sectors. And globally, China has slowed down, they've put curbs, and therefore, on the other hand, Indian production is kind of picking up, and therefore the demand for metals is picking up in both domestically. And second, is the valuations of the metal companies are very reasonable at about 5-6 times EV/EBITDA. Against that backdrop, any catalyst that is that you're seeing any incremental spend by whether it is domestic or outside the country will act as a spur for additional growth in the metal sector. And auto ancillaries is a function of what the auto companies do. Auto companies are benefiting from the GST rate cuts. So whenever you buy an automobile, all the ancillary, the auto parts, which go into making a car or a bike, or also those companies will benefit.
right. Last question. So what's the one concern that you have at this point of time?
The main concern at this point in time is the uncertainty. Markets don't like uncertainty. The market is expecting probably a November-December resolution to the punitive 25% rate. Now, the longer that drags on, the longer the uncertainty continues. And that will be the single biggest catalyst, positive catalyst, if and when to move.
Right, Chakri, thank you so much for joining me. And what are FIIs selling? Foreign portfolio investors have dumped shares worth about 180,000 crore rupees or 1.8 trillion rupees in the last 12 months, with oil and gas, information technology, and auto companies bearing the biggest brunt, according to a Business Standard article. Overseas investors have sold oil and gas stocks worth about 57,000 crores, IT worth about 53,000 crores, and auto about 35,000 crores, totaling about 1.45 trillion rupees or 80% of the net selling, according to an analysis of data provided by Prime Database quoted by Business Standard. The de-dollarization march. India's Reserve Bank has unveiled fresh steps to enhance international acceptance of the rupee, joining efforts by regional peers to globalize their currencies amidst all the tariff-related trade disruptions that we've been seeing, according to a report in Bloomberg. The Reserve Bank of India plans to introduce reference rates for currencies of India's biggest trading partners, the Reserve Bank said in a statement on Wednesday. Currently, those rates are provided for dollar, euro, pound, and yen versus the rupee. The Reserve Bank is now looking at the Indonesian rupiah and the UAE's dirham as benchmark currencies for reference rates, Deputy Governor Ravi Shankar said in response to a Bloomberg question at a post-trade decision briefing in Mumbai that was on Wednesday. China, among other countries, has made similar moves to globalize its currency amidst all the tariff-related uncertainty that we've been seeing. US tariffs on Indian goods are the highest in Asia, which obviously weigh on export earnings and are part of efforts to deepen the rupee's push in global trade and reduce the reliance on the dollar. It's all about decentralized finance. Decentralized finance, or DeFi, is an emerging financial system using blockchain to enable direct transactions between individuals and businesses, but it can play a specific role and a key role in areas like supply chains where the seller or buyer is able to transact with greater comfort and confidence. In countries like India, of course, there are ventures which ensure that there is a proper point of KYC connect with the financial world, or what is known as the off-ramp and on-ramp platform. All of which becomes important in the context of India's new Digital Personal Data Protection Act, or DPDPA. I spoke with Dr. Nikhil Varma, Associate Professor of Management at Ramapo College of New Jersey and a technical lead for India with blockchain company Algorand Foundation in our Building on Blockchain series. And I began by asking him how he was seeing the role of decentralized finance play out.
So to start with, the whole idea of supply chain is the value chain around an organization, how things move from one place to the other. And when things move, when there is an exchange of value, there has to be some kind of a financial interchange. And to start with, because blockchain was more or less against the state kind of a framework when it started out, the idea was that, okay, let's do the whole of supply chain in the blockchain because blockchain does not need to wait in line for permits. That's the kind of mindset we started out with. But the problem is that if we had continued on that rogue path, this would never be mainstream, right? And that's why most of those rogue elements were associated with blockchain. Now, coming back to the real world things that we can do in a supply chain, that the kind of interchange of value that happens, suppose you buy assets, you trace assets. What we need with a blockchain-based solution is something like a GPS, which not only tracks but gives you direction, right? And what was required in this area of blockchain diffusion in supply chain is to be able to make sure how can we have an infrastructure that is already compliant to the laws of the land, right? So blockchain makes payments trustless, parties interact with one another, payments seamless. And not only that, there is more to it by adding another layer of decentralized finance, where you could have underwriters taking risk, you could have micro insurance coming into play, you could have better visibility of the asset, you could actually know which asset is in the manifest on real-time basis, and it's immutable, it cannot be doctored. So a lot of things will transform because of DeFi being embedded into supply chain.
So tell us about where it's more applicable than, there must be some areas or some kinds of industries, for example, where it's more applicable right now and therefore becomes a more or a better use case.
So one of the things in supply chain, the biggest issue is that payment processing does not happen in real time. Okay, whenever we exchange goods, there is a net 30, there is a net 60, there is a net 90, there is a net never, all kinds of things happen. And what we need to bring into play is a mechanism to be able to get liquidity when I exchange goods, because otherwise that's where the risk factor comes into play. As a farmer, if I'm growing crop and if I am not able to get liquidity, I'm going to be stuck in that cycle of poverty because I want to go to the loan sharks and take money. Now, what happens is these farmers have to sell their crops. I'm just giving you an example. Might not be the only case. The farmers selling their crops. Now, there is an integrator who has lots of money, so they are able to buy that crop at a lower price. And then they are controlling power in that ecosystem. This usually happens in most of the supply chain constructs, if most of the supply chain of the current times, that there is one party who has money is controlling power, and lack of liquidity or lack of a fair model for people to have access to money when they need it is what is creating these power centers in supply chain, right? Now, how do we kind of democratize it? What we will be able to bring in is with DeFi, you could get decentralized finance funding on a real-time basis, which means a farmer at the time of raising their crop can actually tokenize their future crop. With the risk outlook of the market, there could be an underwriter who could give them a line of credit and they would not get stuck in this cycle of poverty. This is just one simple example, but now you can see anybody who's getting raw materials for a future contract can possibly have a future-looking contract instead of going to a bank and putting in all those documents. You could have a much lighter process. Of course, it has to be regulated. It has to follow the laws of the land. But access to capital becomes easy. And when access to capital becomes easy, then things become more fluid, becomes more democratic, and you have less power players in the supply chain.
Right. And what's a good use case in India right now?
So one of the use cases that we have very interesting is the company LW3. Now, this is a slightly different kind of a supply chain where they are looking at a battery return process. So a battery return process, EV battery return process, we will be seeing a lot of EV batteries being returned in the next 7 years because they have a shelf life of about 7 years and we've just started getting into the EV space. This whole return process would be very capital intensive, as you can imagine, because battery at the end of their life, there is a salvage value to it. Just let's simply put, yeah. Now that salvage value has to be transported from the person who has the EV battery all the way up to the recycler. Now, if we have to actually look at the current systems in play, the current systems was set up for a forward logistics process, not for reverse logistics. None of us actually went back to any store and gave our whatever part of our car and that would go back to a recycler. There was no process set. So that capital expenditure would be way higher and the return of investment for the battery would take longer. So most big players will only be able to come into play. So what LW3 has done in a very interesting manner is the Uberization of this return process, which means the value of the battery is locked into a smart contract every time it switches hands. So if the person gives it to a place that stores the battery, of course, the storage place has to be validated by the ecosystem. The person will get money right away in their wallet. When the storage place gives it over to a logistics company, the logistics company owns the battery now. The storage place will get money. And when the logistics company hands it over to the recycler, the logistics company would get paid in real time. Now, I feel that this is a game changer. This kind of models can be built across multiple frameworks. Of course, there is an on-ramping and off-ramping because at the lower level, we have to kind of deal with tokens to be able to transfer the value. But on the user level, it's all paid in rupees. So the on-ramping and off-ramping has to have some kind of a regulatory oversight. That is why there is another company in our ecosystem, in Algorand's ecosystem called Carrot, who have built this on-ramp, off-ramp SDK, software development toolkit, which can be integrated with all these applications, where each of these parties are KYC'd or KYB'd, whatever be the case. And whenever they receive a payment, they follow the whole regulatory process to be able to report it to the government and so on and so forth. So this is a beautiful use case which does not require capex and could transform the whole battery return process.
Last question, Nikhil. So what's one area where you see DeFi playing a role which is beyond, let's say, what we are seeing or are familiar with right now?
I feel that DeFi is definitely going to have an impact on our daily lives in a multitude of ways. One of the things that I already outlined is the access to capital, but then there could be things like micro insurance. I feel micro insurance and microfinance are two big areas where DeFi is going to transform people's life. And these people being integrated into the supply chain. So a small weaver can now buy cotton by microfinance through this whole infrastructure because they have a forward-looking contract to anything that is going to be serviced. That, I think, is going to transform lives. This whole idea of Atmanirbhar Bharat, I think that would well be promoted by a DeFi-based rail that would come where people could put in money on a regulatory oversight perspective. That's what we are building. We are trying to make sure that every single thing that is being done will be reported to the government because nothing comes out of the system without a regulatory oversight. But, access to capital, I think, is the key thing. And that's what DeFi would provide.
That was very interesting, Nikhil. Thank you so much for joining me.
Thank you, Govind.
And do look out for insights on blockchain and how it can transform businesses as we count down to the third Algorand India Summit 2025 to be held on December 6th and 7th at the ITC Gardenia in Bangalore. You will find a link to that in our description. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.